What if I told you that the next time you walk into a bank, you're actually stepping into a system built by farmers? Not kings, not priests, not merchants, but farmers. It sounds ridiculous at first. How could people who spent their days tilling soil, worrying about rain and harvests, possibly be the inventors of something as sophisticated as banking? But the truth is, the roots of our entire financial system, saving, lending, even interest, can all be traced back to the humble fields of early agriculture. The story of how this happened begins long before the first coins were minted. Before money even existed, when the world's wealth wasn't stored in gold, but in grain. Thousands of years ago, humanity was living hand to mouth. We were hunter-gatherers, following herds, picking fruit, moving constantly to find food. Then came the agricultural revolution, arguably the most important transformation in human history. People learned to domesticate plants and animals, to stay in one place, and to grow more food than they immediately needed. Suddenly, for the first time, humans could have a surplus, a small mountain of grain left over after everyone had eaten. That surplus changed everything. It meant safety, stability, and the first glimmer of wealth. But it also created new problems. How do you store it? Who keeps it safe? And what happens when your neighbor runs out of food before the next harvest? Grain, unlike money, can rot. It's vulnerable to moisture, pests, and theft. So early farming communities developed ways to protect it. They built communal granaries, shared storehouses where people could deposit their excess harvest for the community's use. These early storage systems were more than just barns or silos. They were the first prototypes of vaults. Each farmer would bring in their share of grain and in return receive a record or token representing how much they had stored. These tokens could later be redeemed for the same amount of grain or traded with others who trusted that the granary would honor the promise. In that simple act, we find the earliest version of a deposit slip, a receipt, and even the concept of credit. Imagine being a farmer in one of these early villages, maybe somewhere along the Fertile Crescent of Mesopotamia, around 10,000 years ago. The harvest has been good this year, but you know the rains might fail next season. You store part of your crop in the community granary to prepare for the worst. But one of your neighbors, less fortunate, comes to you asking to borrow some of your grain until his crops recover. You agree, but you ask for a little more grain back when he repays you. Compensation for the risk and the wait. That extra portion? That's interest, born not in a temple or a marketplace, but in a field between two farmers trying to survive. It's fascinating how this small, human arrangement, the simple act of lending grain, laid the groundwork for an entire global system. Farmers didn't think in terms of financial theory, but they understood time, value, and risk. If you gave away some of your stored food now, you'd need a reason to believe you'd get it back later, and with something extra to make it worth your while. Over time, these lending practices became more organized, even institutionalized. Communities began to rely on certain trusted figures to manage the stores, keep track of who deposited and who borrowed, and ensure fairness. Those people, often respected elders or temple workers, were in essence the first bankers. In ancient Mesopotamia, this idea took on an extraordinary form. Around 3000 BCE, temples weren't just religious centers, they were economic hubs. People brought their grain to the temple for safekeeping, and temple administrators recorded the amounts on clay tablets. These tablets became the first ledgers. If someone wanted to borrow grain to plant or to feed their family, the temple could lend it out and expect repayment with interest after the next harvest. The interest rates were often standardized, sometimes as high as 33% for grain loans. The very notion of percentage-based repayment, still used today, originated here in the counting rooms of temple granaries. Now, why did temples play this role? Because they were trusted institutions. People believed that the gods themselves oversaw fairness and honesty. Temples had strong walls, organized systems, and a moral authority that made them ideal as early banks. And while today's banks rely on digital ledgers and encryption, the logic is the same. A trusted intermediary keeps records and ensures that promises are honored. As societies grew, these grain-based economies became increasingly sophisticated. The Sumerians, for example, didn't just store and lend grain. They developed a full accounting system using cuneiform writing. They tracked debts, payments, and due dates with incredible precision. A farmer might owe 10 bushels of barley by the next harvest moon, and the record would be baked into a clay tablet that could last for centuries. These tablets weren't just receipts, they were contracts enforceable by community norms or temple authority. In a sense, they were the ancestors of modern financial documents, and the clay tablets were the world's first data storage devices. But the brilliance of ancient farmers wasn't just in record keeping. They also pioneered the concept of collateral. If you borrowed grain but failed to repay it, you might have to surrender part of your land, your livestock, or future harvests as compensation. This principle, securing loans with assets, remains at the heart of modern banking. Every mortgage, every business loan, every car payment still echoes that same logic born in the fields of early farmers. As trade expanded beyond villages, years, these agricultural credit systems had to evolve. People began to trade grain receipts instead of the grain itself, because it was easier to transport a small clay tablet than heavy sacks of barley. This shift was monumental. Those tablets, representing stored value, could circulate between people who trusted that the temple or granary would honor them. They were the first forms of money, not coins, not metal, but promises backed by grain. In essence, farmers had invented not only banking, but the very idea of currency. Now picture how transformative this was. For the first time, value could move without physical goods changing hands. A farmer in one village could pay a craftsman in another by transferring ownership of a certain amount of grain in storage. The craftsman could then redeem that grain or trade the receipt to someone else. What had begun as a practical solution to manage food surpluses had blossomed into an abstract financial system. In these small clay tablets, humanity discovered that wealth could exist as information. This innovation didn't stay in Mesopotamia. Across the ancient world, agricultural societies independently developed similar systems. In ancient Egypt, for instance, the state's wealth was measured in grain stored in massive granaries along the Nile. Pharaohs used these stores to feed workers during famine years, pay laborers building temples, and lend grain to farmers who suffered poor harvests. These transactions were meticulously recorded on papyrus scrolls. The scribes who managed these records were essentially government bankers, ensuring the kingdom's economic stability. Even in ancient China, grain storage systems operated as early versions of public banks. The state maintained granaries that could release grain to stabilize prices during bad harvests or accept deposits during abundance. By controlling the flow of grain, the government managed inflation and ensured food security, economic policies that sound strikingly modern. Farmers, through their management of surplus and need, had forced societies to invent macroeconomics long before the word existed. As time passed, the concept of stored grain value merged with trade. Merchants began to use the same principles of lending and borrowing that farmers had developed, but applied them to goods like textiles, metals, and spices. Yet the underlying structure remained agricultural at heart: trust, record keeping, interest, and repayment. When coinage finally appeared around 600 BCE in Lydia, it didn't replace the farmer's logic. It simply made their ideas more portable. A coin was just a new kind of grain receipt, one that fit in your pocket instead of a clay tablet. By the time ancient Greece and Rome refined their financial systems, the old agricultural DNA was still present. Roman banks, for example, still referred to their main reserve as a granarium, literally meaning grain store. The metaphors of harvest and seed investment persisted too. To sow money for future yield is an idea that comes directly from farming. Even today, when investors talk about reaping profits, they're unconsciously echoing the language of the first farmers who lent out their barley hoping for a larger return at the next harvest. What's truly poetic about this story is how it reveals the human instinct to prepare, to plan, and to trust. Early farmers didn't just grow crops, they cultivated time itself. They understood that effort now could bring reward later, and that the future had value. That realization that the future is worth investing in is the essence of finance. Whether you're planting seeds or funding a startup, you're expressing the same ancient belief that something small today can become something great tomorrow. Modern banking began with farmers who stored and lent grain, creating the first systems of saving, credit, and trust. Over time, these simple practices evolved into laws, banks, and today's digital finance, proof that our global economy still grows from the roots of the ancient harvest.